Hi, this is Steve O'Hare. It's the week of 11th of October 2021, and our trade of the week this week is Eurodollar. Now, from the fundamental side of things, we saw US non-farm payrolls come out on Friday, and they came out at 194,000, which was well below the consensus forecast of 500,000, although the August increase was revised higher to 366 from 235k. Private payrolls increased 317,000 for the month, with an increase of 26,000 for manufacturing employment. So there was a firm rebound in retail jobs of 56,000, while other service sectors were broadly subdued. Government jobs reported a sharp decline of over 120,000 on the month. The unemployment rate, however, declined sharply to 4.8 from 5.2 and below consensus forecast of 5.1, as the household survey indicated strong employment gains. Average earnings increased 0.6% on the month, with an annual increase of 4.6% from 4% previously. The dollar dipped lower in an initial response to the data. There was choppy trading during the session. The largest decline in unemployment and strong household survey maintained expectations of Fed tapering, with limited potential dollar selling, and euro dollar settled around about 115.70. CFTC data recorded the largest net long dollar position since June 2019, while there were further sharp reversal in euro positioning with short contracts of over 22,000, the largest short position since March 2020. The sharp shift in positioning will maintain the risk of a sharp dollar retreat if US confidence slides. US bond markets closed today, Monday, which will dampen activity, but the dollar overall was trading near a 14-month high. So how does that translate into the technical aspect as well? So let's jump down onto the weekly chart in euro dollar. Now we are forming a bearish head and shoulders formation. This is one of the really reliable formations within technical analysis. Now the neckline, we saw the neckline break around about mid-July, and we tested it even as far as sort of second week into September. But since then we have started to break down. We're also breaking the horizontal supports. 117.04 was taken out, and also we've seen 116.12 taken out, with last week the majority of price action sitting below this resistance level. Now it was support, now turned into resistance. So from a Fibonacci retracement perspective, we've got 50% of the previous up move. That support comes in just below the 115, the figure, and 61.8, which is one of the normal Fibonacci retracement levels we look for, comes in just below 113. So they're levels to look out for more on a longer term basis. The daily chart, we can see price action has been below the Ichimoku cloud, which is our trend following tool, and that's been below there since mid-June, and as the cloud has acted as resistance on a number of occasions, and we got this really nice 119.08 level of resistance, which has been the start of this down move now. We can see on the RSI we've corrected from oversold conditions, and bearish momentum is stalling on the daily chart, so we're being aware of that, but the 116.12 level sits as solid resistance above currently. So on the 4-hour chart we can see this nice bearish trend channel, which is capturing price action at the moment. We're just below mid-range of that. We can see the 4-hour channel has a 4-hour Ichimoku cloud resistance above. We're looking at levels really now at 116.40 up to 116.65. That'll be the resistance range for price action at the moment, and we can see this mild corrective phase that we've gone through over the last couple of days. So price action remains negative in euro dollar. We expect further downside over the coming weeks, and really looking to see or requiring a break of the 115.20 to 25 level to see this move accelerate further to the downside. Risk to the upside is a break back above 116.40, should really open up a more deeper correction higher. However, we are and remain in a downtrend on euro dollar. Thanks for joining me.